Hello and welcome to YP Investors Quick Tips. In today's episode, we'll be going over inflation. And what we need to know about inflation is that it happens every year for the most part. And what it does is it decreases the value of the US dollar or whatever country that you're in. If they have inflation, it'll decrease the value of the dollar. What does this mean? This means that, let's say there is a can of pop for $1, and if the inflation rate was 100% that year, that means the can of pop is now going to cost $2. So the value of the dollar went down, meaning you needed more dollars to buy one can of pop. And in the US, the inflation rate is on average 2% a year. And this is very important and something that you need to take into account when you're investing. If you have money in a savings account, as you can see on this YP Investors homepage, we have the average yearly market return rate, the savings account rate, and then the inflation rate for 2018. So as you can see, if you had your money in a savings account, you made 0.17% on average. And then if the inflation rate is at 1.9%, you're actually losing money by leaving your money in a savings account. And if you have it in a general market fund, you're going to be making on average 10%. So having your money and your savings in something other than just like a savings account that's going to beat inflation is how you're going to be able to keep up with it and to make money, rather than just saving your money and letting it get worth less and less as the years go on. And if we go over to the other picture we have on YP Investors homepage, you can see if you leave your $1,000 and you never add any money to it, and you left that into the bank in a bank account for 10 years, you would end up with $1,117, or excuse me, $1,017. If you did the same thing and just put $1,000 into a general market fund, you'd end up with over double the amount of money, $2,593. And then let's take into account the inflation rate. So let's say it was 2% a year for 10 years. So inflation is going to be 20%. So now your $1,000 is actually going to be worth, in 10 years, it's going to be worth $1,200. So you have to have $1,200 to equal the $1,000 you had back when you started investing. So that means you actually lost over almost $200 in value if you kept it in a savings account, because you have $1,017. And the value of it is now $1,200. That's the equivalent value of the $1,000 that you started with. And if you have it into an investing account, you actually doubled your money and you're sitting pretty good. So YP Investors quick tip for today is to always know and keep in mind the inflation rate, whether you're at your job, investing, or whatever you're doing with that involves money. Because let's say if you're at your job and you get a 1.5% raise, well, a lot of people might be happy, but historically, inflation each year is about 2%. So you actually got to pay a decrease, because if you got a 1.5% raise and the inflation rate's 2%, you're actually losing 0.5% of your salary. So that's always something to keep in mind when your yearly raises come around, and maybe you want to talk to your manager and say, I need at least the inflation rate. It's just something to keep in mind, especially with your investments as well, whether it's in stocks and bonds or other investment opportunities like real estate. Just make sure you're at least making the inflation rate money back, but you should be making more if it's an actual investment. So you want to be always keep in mind the inflation rate. That's all we have for you today. Thanks for joining us on YP Investors Quick Tips. If you're not a member, check out our homepage and become a member.